Good morning. Thank you, everyone, for joining us this morning for our first breakfast seminar via webinar. Unfortunately, it's a breakfast seminar without minus a breakfast, but we look forward to a face-to-face event with you at some time in the future. We're always aim with our breakfast events to have two-way interaction. So during the presentations, you can submit questions by via the link at the bottom of the page. So please do submit questions. We'll aim to respond to them both during the presentation and during the Q&A session at the end of this morning's event. We will have a hard close at 10 a.m. So I'll aim to bring things to a close as chair at that time. In terms of our agenda today, I'm delighted to welcome our guest speakers, Patrick and Ajeet. Patrick is a partner and actuary at Hymans Robertson, and he was a member and is a member of the industry working group that's working with the TPR on the funding and very much the topic of today's event. Ajeet is co-head of the River and Mercantile Solutions business, providing investment consulting and FM services, fiduciary management services to UK schemes. Our topic is really about helping trustees and advisors ensure schemes are developing long-term funding objectives and long-term funding plan. We've seen the pension regulator aiming through its business plan to really focus on helping ensure that savers' benefits are delivered. And we've got this new term of savers applying to members of DB plans. And the regulator is looking to intervene where appropriate to ensure trustees define and meet their long-term objectives. So the framework that is in consultation is really very much aimed at schemes getting to self-sufficiency or on new term low dependency with a very clear path to achieve that. And integrated risk management is going to be the focus of how that's delivered. So today's objective for us in helping you with thinking about long-term funding objectives is to address those IRM principles. So what I'll do now is hand straight over to Patrick, and he'll take you through the first session.
Hi, thanks, Roger. Morning, everybody. There's a lovely picture of me and what I used to look like back in the days we all took the train into London. Let's move on from that as quickly as possible. So TPR's new funding code of practice. I've got about 20-25 minutes of allocated for this. You've got the Q&A box at the bottom of your screens. If you'd like to tap any questions in on things that we're speaking about at the time, I'll try and take them as we go, but there's a little bit of time for wash up at the end. In terms of structuring, my session is going to focus more on the fast track test itself and some of the politics and the legalities of why and how it's working. And then Ajeet's going to talk about the practical implications of it, just to give you an idea of where to slot your questions in. So, why do we need this new regime? I think this is really useful to set the context, because it's very easy to just not see the wood for the trees and dive straight into the detail. Now, I appreciate some of the numbers on the slides here are too small to see. Don't worry about that. The themes are clear. That's just so you can enjoy it at your leisure if you have a look at the slides afterwards. Current funding regulation we have comes from the 2004 Act, as I'm sure everybody knows. Just to give a bit of context, the biggest selling single in 2004 was Hey Ya. Tony Blair was Prime Minister. And when the regs came in 2006, that was a year before iPhones got launched. So that gives you some idea of quite how aged our current legislation is. In particular, in pensions world, it was written with open schemes in mind, which even by 2004 was a little bit out of step. But by now, it's vastly out of step when we're seeing 46% of schemes are closed entirely, and there's only a very small proportion of schemes that are still open to new members at all. So it's past its sell-by date. Is quite a simple point, and it doesn't cater for the vast majority of private sector schemes which are closed and should be thinking about eventual runoff. The second really important theme that allies to that is cash flow negativity. So this is about schemes that are closed will eventually start disinvesting their assets and paying them out to pay the pensions, which no rocket science in that. It's what pension schemes were always supposed to do. But the theme about what that does for a scheme in terms of how you manage its investments hasn't been well understood until quite recently. So I've put some figures on there from some work we did in 2006, saying even back, sorry, not 2006, 2016, even back then, half of FTSE 350 schemes were cash flow negative or were about to flip into cash flow negativity, but only 1 in 20, 4%, sorry, that's 1 in 25, 4%, 1 in 20, we're good, were thinking about it, 4% of schemes. So that is a key theme about this longer term planning, thinking about cash flow negativity and getting ready before it's upon you. The third theme in the bottom left-hand corner is about scale. If we think about the DB universe of schemes, it's a bit less than 5,500 now, which, again, we go back to 2004, it was 7,800. So you see how the industry has shrunk. 2/3 of those schemes have got less than 100 million of assets. And even more starkly than that, 40% of schemes have got less than 20 million of assets. So we have a vast majority of UK DB schemes are subscale. And the practical issues of that are the governance budget and the advisory budget to do things well. So for people, I'm sure anyone dialing into this call, you're involved in high quality schemes or you're high quality advisors, this probably isn't the universe that you're operating in. So you might think that all this legislation and regulation is not really for us. It's what we were doing anyway. It's not really necessary. It's aimed at these guys. It's aimed at the small schemes. And there are associated themes running alongside this about consolidation as well, about dealing with the smaller end of the market and improving saving, no matter how big the scheme that your pension happens to sit in is. And the final thing is about TPR getting quicker access to its powers. And there's a quote there from Frank Field off the back of Kodak, but I think we'll bounce straight on to have a look at the politics of this. I put up a timeline. And starting in 2017, this was Richard Harrington. He wasn't that long as pensions minister. He did a green paper, which I'll paraphrase as saying, everything's fine, folks, nothing to see here. Then, not too long after that, we had BHS, Carillion, some other unsavoury things, and Frank Field on the Select Committee really laying into the industry to challenge it, which was with some reasonable justification, I would say. And that led to the white paper, which and a different pensions minister by now, saying maybe everything isn't okay. But the conclusions that were coming out of that were actually the suite of powers TPR had were pretty good. They were pretty comprehensive. So Frank and Co. said, well, if you've got these powers, how come you've never used them? How come we don't see much on the statute book here? And that's where we get to the key point here. It's not about changing TPR's powers. It's about it being able to get access quickly enough to intervene. And if you think about TPR's process of going through the determinations panel compared to the pace of corporate decline or corporate transactions, M&A activity, it's from the wrong era. It just doesn't fit. So that's why we're seeing one of these major changes. The rest of the theme from here on is about legislation going sideways because it's been crowded out by other events. So we've got Brexit happening, then we've got the withdrawal bill, then we've got COVID-19. So pension schemes bill has been around for a while. It just got its first nod through yesterday, I understand, in Parliament. So it looks to be going ahead, and that will embed the need for a long-term objective and a new document called a funding and investment strategy, which is a kind of IRM summary that DB chairs will need to sign off. And alongside that, TPR is now consulting on its new framework, which is all about enabling faster access to its existing powers. There's going to be a second consultation. That second consultation will cover the actual parameters that TPR is proposing itself, because at the moment it's talking about principles and it's tried not to get stuck on any single bit of detail. Talking about principles, so we'll get the actual fast track specifics in draft, and we will also get a lot more detail, we hope, on the governance around bespoke and how do trustees submit and how will TPR operationally discharge these duties, which are all missing from the first consultation, but given it was 146 odd pages long, I think that's fair enough. We didn't really need any more in that one. In terms of timing from here, Everyone's quite ambitious about the pensions bill going through this year. There's going to need to be a lot of supporting regulation to bring this all to life, because the Pensions Act is pretty skimpy on detail. Whether that's all going to get done in 2021, I think that's a little ambitious given other things that are going on, but that's the ambition. So the earliest we'll see this in force will be valuations in 2022. I think there's a better than evens chance it might drift by a year, but there is strong political will to push this through. So that's our backdrop into why and what's going on. If we have a look at TPR's fast track test itself, the first thing I'll say before we go through the lines is, why has TPR settled on this fast track, and why is it trying to set a codified standard? And there's been lots of criticism, mudslinging, questioning, call it what you will, about, isn't this MFR2? Aren't we setting a default standard? The true plot underneath this is, for TPR, it's an access point to their powers. You'll have all seen their new strap line, clear it tougher, quicker. It's for TPR the access point to say, you're the wrong side of the line that we've drawn, our powers are now in play, we can expedite our process through the through TPR and through our determinations panel to be able to use those powers. So that's what it's all about in the first instance. It's not about changing TPR's powers, it's about them getting their hands on them more quickly by being clear. The second thing that this fast track does is, going back to the theme I mentioned a couple of slides ago of small and subscale schemes, it gives them a decent vanilla blueprint. If they cut and paste this fast track, it's okay. It's maybe not perfect, it's maybe not perfectly tailored, maybe you'd like trustees to spend a bit more time on it and take more advice, but if they work with this fast track framework and set a long-term objective, a small closed scheme has got a decent chance of being okay. We've had an interesting question that's come in on a bit of a tangent about who should take the lead in forcing private sector DB scheme consolidation. I think that's likely to happen through the combined force of TPR regulating this fast track in practice and the kind of pressures it puts on smaller scheme trustees. And that we'll see more of in the second consultation. How hard will this be to comply with? How expensive is it going to be to comply with? And will that force schemes out? And the other thing alongside that will be the marketplace offering suitable products. Well, for my mind, there are already plenty of good products there. There are DB master trusts that have been around for a very long time that offer different governance models. We've got sole trusteeship as well, which offers a very different governance model at a different cost point for smaller schemes. And then we've of course got the consolidators, which have now got their interim guidance coming in from TPR. That's the one that's getting all the headlines, but it's really about being able to give some choice and stimulate that market. But it needs TPR to turn up the heat. I don't think that's going to happen in the same way as we're seeing for DC schemes, where there's a consultation on saying, prove that you're value for money or you're going to have to consolidate. I think it's going to be more about making life awkward and making life difficult and making the cost of operating a small scheme prohibitively expensive, so that commercially it drives into the hands of alternative offerings, is my take. But I don't see DWP pushing hard for that consolidation agenda. I think it's very much amongst TPR and the practitioners of what do they think is necessary for the kind of governance budget to run a scheme well. In terms of TPR's fast track framework itself, we've got it up on screen there. It's very simply a 4-test framework, and you have to pass all of them to say that you're in fast track. First most important thing, and this is in the Act itself, is about setting a long-term objective. So going back to our original themes, this is schemes are closed, they're eventually going to run off. So what we would like to see, if TPR speaking here, is set a point where by the time everyone's retired, you've got a good amount of assets in the fund. And following on from that, we'd like them to be defensively invested. So technical provisions, there's not a desire to overhaul all of the legislation, so most of the 2004 Act will remain, technical provisions will remain, but it needs to be structurally designed to dovetail in to this long-term objective when it eventually gets there. So long-term objective, details on that, I think it's likely to come out at gilts plus a half, given the headwinds we're seeing at the moment in the economy. In terms of timescale, at the moment, I think if you were to straw poll trustees on who knows the duration of their scheme liabilities, if you got 1 in 50 got the answer right, you'd be amazed. And that would be good. That would be good, 1 in 50. I think this time in 3 years' time, every trustee will know their duration, and they'll know when they're going to get to the point of all members retiring, and they'll know what duration that's at. So that's all those metrics are. TPR's had a look at all the different options around describing that, and picked the kind of least worst, least influenceable, easiest to understand one of duration there. On technical provisions, we are likely to see, I think, trustees, possibly the scheme actuary, needing to certify that all of the assumptions apart from discount rate are no weaker than best estimate overall, and it's just going to be controlled through the discount rate. But I think there's some final toing and froing on that, and we'll see what's come through in the consultation. I'm meeting with TPR in a couple of weeks' time, and I think it's 114 responses they've had to this consultation. So there's an awful lot for them to digest, and they asked a heck of a lot of questions. So there may be some interesting things that come out of that yet. Recovery plans will be interesting, I think. Now, there's not a lot of big policy change compared to the way TPR has been regulating recovery plans through its annual funding statements in the last few years. But what will be changing, I think, is some structural elements. So if you want to be within fast track, you're going to have to strip out any asset outperformance, so make it simpler. And there's going to be a de facto maximum length that's linked to your covenant quality. There's also going to be a constraint about no back-end loading, so you can inflation link, but TPR's not wanting to see big bullet payments somewhere off into the sunset. And then finally, there's going to be a control on investment risk as well, and this is to stop schemes trying to gamble their way out of trouble and get an appropriate balance between cash and investment returns. That's most likely to be a simple stress test. There's been a lot of thought gone into the appropriate ways of doing that, and something that looks not dissimilar to the way PPF does it, I think, is what we're likely to see in practice. I had a couple of questions on resources and capacity and the robustness of fast track. And I think this is a really fair question. One of the things that troubles me is the thought that we may be designing legislation and regulation to fit a budgetary constraint of a government department. I'd much rather see it the other way around, that we design the legislation and regulation that savers in DB require, and staff up and provide the budget for that government department that's appropriate. So there's a really big question. I'm sure someone will ask at some point, what proportions do we think will go down fast track and what proportions do we think will go down bespoke? And I'll put my next slide up so you can have a little look at that whilst I'm chatting. No one knows. Guesses that we've seen, straw polls that we've seen on webinars and surveys we've done with clients have suggested possibly half and half, but no one knows. And it depends on where TPR draws the line for fast track as well. So TPR has got a couple of competing pressures. If it sets a very stiff fast track test, it won't get enough schemes into it, and it'll end up with an unmanageable workload through bespoke. And if it sets the fast track bar too softly, if it sets that LTO too low, then we may see quite a lot of levelling down, and it runs the sort of Daily Mail headline risk of schemes that were going to be fine and had a better deal fall onto fast track, sponsor goes insolvent, and the members say, I'd have got a better deal if TPR hadn't set its regulations, you've let me down. So there is a balance here, and I think that balance is something that's forever going to be shifting. It's never going to be nailed down. It's going to have to move over time. And one of the things that I've pressed for, and that I've seen in a couple of other consultation responses as well, has been that TPR gives itself the room to move. As we saw a moment ago, the 2004 Act under Tony Blair's era looks pretty dated now. And these regulations will similarly date. It's inevitable. So we need to build in the operational flexibility for it to change with the times, and particularly change with the economic climate that we're in. So on screen, we've got how TPR envisages this working, and this is, I think, a little idealistic, but let's give it a run anyway. So in TPR's head, trustees and sponsors do valuations as they always did, as if the fast track didn't exist. You arrive at your deal and you've done the best job that you can for members, and trustees are on the ball and all of that good stuff. You then apply TPR's fast track tests, and if you pass all 4 of them, great, you get a letter saying thanks very much, no further scrutiny. And if you don't pass all 4 of them, you then fall into bespoke, And that means you are subject to TPR scrutiny, but to the point I mentioned earlier, and more importantly, TPR Section 231 powers are now in play. And I think within that, there'll then be three subcategories. There'll be some that there's a small fix and you're pretty close to fast track. So what we're thinking of as fast track equivalents, and I think this is a mini industry that we're going to see quite a lot of work in over the next 5 or 6 years. And that's where you might have a recovery plan that's just a smidge too long because of sponsor constraints, but some contingent asset or other sort of pledge that makes the overall quality of the package, props it back up to be equivalent to fast track. So there's likely to be some light touch scrutiny of that, but otherwise TPR will say, you were close, you were off here, but you've patched it in some other way, and that's good enough. Through you go, thanks very much. We'll then get into the really genuine bespoke ones, and I think those are in two camps. We'll either have the schemes that have a philosophical or commercially fundamentally different view. The largest category here, I think, will be those that want to pursue runoff and CDI, where you can support quite substantially higher discount rates with income matching portfolios. Or we might see ones that think they should be able to continue running risk. And TPR is yet to really say how it plans to regulate those. And the biggest challenge I've heard across the industry as a whole to TPR has been bespoke needs to be bespoke. And the 2004 legislation, which this sits on top of and doesn't replace, remains scheme specific. So this is the real hotbed of saying, are you imposing an MFR? Are you going to try and regulate everybody back to fast track? Or is that just a yardstick so that you've got the right powers to be able to then engage with an appropriate number of schemes around this optional bespoke area? All of that will depend on the sorts of things that will be spoken about in the second consultation, but also how TPR regulates in practice and how schemes and advisors behave. So it's definitely the one to watch. In the conversations that I've been a part of with David Fairs and other webinars I've turned up to where TPR has been speaking, they've spoken quite accommodatingly around this, around understanding the point and even saying that industry's perhaps misread them a little bit. So I think that's an area that will get discussed quite a bit and clarified. And then finally, we've got the constrained ones, and those are schemes with basket case employers or terrible funding, where you're simply in the realms of doing the best deal possible, and TPR's intervention there will be primarily around protecting the PPF and making sure that trustees have scraped what they can out of the sponsor. So I think nothing very different to what you're seeing in annual funding statements over the last couple of years. So if that was the utopian version of trustees and sponsors do their valuation first as if none of this existed and then carry on to apply the tests, what's the reality going to be like? And I think it's going to go a bit more like these three steps, which is, first of all, trustees and sponsors will have a look at which fast track line they would be on depending on their covenant. They'll pick the one that's relative to them. That puts us into box 2, where they'll then overlay their current strategy onto fast track rather than it being the other way around, which TPR would like to see. They'll have a look at where they're out of kilter, and they'll make a few changes to bring it in line. So what we'll be seeing here is TPR's fast track operating to drive funding. And in many ways, all that would really be doing is pushing TPR's regulatory intention into the work that trustees and sponsors are doing already. So it's regulating before the point rather than regulating after the point. All advisory firms, I'm sure, will develop models around optimizing for fast track and being able to tell their trustees and sponsors where the gaps are, what they can do to bridge it, what the different size and shape of fixes are, all of those sorts of things. And in particular, I think, as I mentioned earlier, we'll see a lot of restructuring of recovery plans. And much of that, I think, will be to end up with the answer that you first started with, and just re-expressing it in a currency that fits more readily within fast track. So things like stripping out asset outperformance and changing end dates and changing the profile of payments within recovery plans, those sorts of things, without fundamentally changing the underlying cash commitment that's being made. We will see a number of schemes that will need to toughen up. I think this long-term objective is a noose that's going to continue to tighten. Now, if we think about that for a moment, I'm an actuary, so we tend to think in pictures, and these sorts of ones are quite useful to me. So if I look at the one on the right-hand side in box number 3, we've got the amount of money is up the page and time is across the page. Schemes need to get to having a decent amount of money in the fund by the time everybody's retired, and that money in the fund needs to be defensively invested. So you'll throw cash in to get back on this technical provisions line, and that then needs to strengthen over time until we get to the point where everyone's retired. All well and good in theory. I've never seen an actuarial projection that's turned out to be true, speaking as an actuary who's been doing this for 25 years. So what will happen if the economy goes sideways or assets disappoint? That's going to put quite a bit of pressure on, because the timescales won't get further extended. You won't be able to kick the can down the road, and that's where this noose is going to tighten over time. And the underlying point here, I think, is quite serious. If you widen it out to the macro view, that TPR sees a structural view of the whole DB landscape having 20 years, 15, 20 years to get to this point. And if we make steady progress, it never needs to stress anybody. But if we don't make progress, that noose is going to tighten, and that's going to cause some problems. So a final couple of words from me. I mentioned everyone will have their tools and gizmos. If you want to have a look at ours, we've got a freebie online already based on where we think it's likely to turn out. So you're welcome to go online there and play with any scheme that you like. And a final word of how's this likely to change from here? Well, I think this LTO and fast track framework is a done deal. It's going to happen. It's the access point to 231 powers, and it's needed. What's going to change the parameters within it and the bespoke scrutiny and enforcement process, which I've spoken about, that there's a lot to come still on that. The other thing that I mentioned, which I think one is to watch out for over the next 6 months, is protecting against levelling down. So this is the Daily Mail headline risk that I spoke about, and that's an area that, again, will be in the second consultation, I expect, but one that's a particular hot potato that's yet to come to the fore. And well, that's it for me. I hope that's been interesting and useful. I'm sure some was familiar. Hopefully a couple of bits of that were new. I think I'm handing straight over to you now, Ajeet.
Sure. Thanks very much. And good morning, everyone. Nice to see so many of you join virtually today. So in terms of what I'm going to talk about this morning, it is very much to think about things from an investment implication perspective. In terms of what are they, given the discussions around funding development and what we need to be doing, how does that impact from an investment strategy? Now, I started my career some 20 years ago doing asset liability modeling for schemes and projecting schemes from where they are today to where they're trying to get to into the future. But as Patrick alluded to earlier, scheme dynamics have been changing. Schemes are no longer open. Many are closed to new entrants, future accrual. And as such, the time frame is shifting. And with guidance from TPR, talking about longer-term funding targets, when I think about investment strategy today, my premise is often to go, well, let's start with the end in mind. So what does that potentially look like? And there are 3 boxes that I highlight on this page just to set the scene. On the left-hand side, what does my longer-term objective look like? Again, Patrick sort of alluded to this notion of low dependency on the sponsor, a prudent discount rate to support that. But what about buyout? And again, where does that fit into schemes in terms of where they are today? So often the starting question is, okay, well, I am where I am today, but how far am I away from this longer-term objective? Secondly, what does it mean in terms of time frame and scheme maturity? The regulator highlights the importance of being in a strong funding position, having a strong portfolio of assets versus that value of your liabilities as schemes get more and more mature. But again, it's important to think about durations, one measure, but as I'll touch on in a moment, this aspect of time frame will vary from scheme to scheme, depending on their membership profile or the dynamics going on from that perspective. So how do trustees factor that into the equation? And then thirdly, this notion that in an ideal world, the regulators are very keen to see schemes progressively de-risk their strategy, the level of assets they have on risk or proportion of growth assets down to a much lower level over the longer term. Again, that notion of having that strong funding position but equally running that in a relatively low-risk way, both from an assets perspective as well as from a liability standpoint. So that's very much highlighted on the right-hand block in terms of that notion of having 80% of your assets off risk as a perhaps longer-term aspirational goal. But for me, there are two key takeaways when I sit down to talk to trustees about where they are. And that in specific terms thinks about where you are today and how that journey is going to evolve going through time from here. Because at the end of the day, progress from where you are to whatever that longer term objective is really, you've got two key aspects that you need to make sure are balancing together. One is clearly in terms of contributions, and again, the extent of sponsor support, not just over the next few years and going forward. One of the questions earlier was around, again, how do we think about covenant assessment? It is a challenge, I have to say, in terms of we work very closely with other scheme actuaries, other covenant advisors across the market, and very much the information they have at their disposal, it looks at the strength of the covenant balance sheet today, plus or minus a few years. And clearly, given COVID, some of those even projections over the next couple of years have certainly taken a different step. But that does highlight the question, going back to my notion of starting with the end in mind. Where is the covenant going to be over the next 5 to 10 years from now? To what extent is the covenant going to be there to support me? And how does that impact on my journey? And that shouldn't just be about financial risks, but increasingly we're talking to trustees about how do some of the ESG risks, environmental, social, governance risks, also feed into that covenant assessment. So again, that landscape is coming together to take a much more holistic view about where schemes are and sponsors are today. But the other key lever is investment return. If we think about the journey, you've got a pot of assets, you can have money coming in, but also you've got to generate return from those assets today to get ourselves making that progress. And for me, the key point here is that decisions you take today when it comes to investment strategy will have a significant bearing on that journey towards your end goal. If we de-risk too soon, that might materially extend our time frame and not necessarily be consistent with where the regulator is looking for us to go. If we're overly focused on shorter-term objectives, whether around funding or in terms of looking at technical provisions or otherwise, again, anchoring our investment journey around that may have an impact further down the line when we can less afford to take risk. So to put that into some context, just moving my slide to the next slide, where are your scheme today in terms of those milestones? This is one of the things that I will often have when I'm sitting down with clients to think about that investment discussion and think about your scheme milestones from here. Again, what the chart you see here is just a simple projection of a scheme's payments, benefit payments going out, going forward. And what we overlay along the bottom of this page is just to highlight some specific milestones that schemes will be thinking about. Cash flow negativity, Patrick highlighted earlier. Candidly, a dynamic of any scheme that's closed to new members in future accrual, if you're not cash flow negative yet, you certainly will be very soon. Secondly, contributions. Again, what does your current contribution ladder look like? Not just in terms of how much of those pension payments is that supporting, but again, how far into the future am I reliant on my sponsors today? Because that in itself has a key factor in terms of how the pot of assets is growing going forward from here. Again, you might not be using all of those contributions to meet pension payments today, but you will likely be in the future. And once those contributions stop, there's full reliance on the assets to generate the right level of income to support pension payments while meeting your objectives. And then as you move further to the right, again, when do schemes get more mature? When do their cash flows peak? Again, identifying key milestones we think is key in helping you frame what you're doing today and how you evolve from here. Moving on, think about covenant. Again, what you're seeing just as a sort of quick aspect on this chart, it's just showing different investment return paths, just to simplify that notion of how much do I need to rely on my covenant today, that vertical axis, versus how long do I have and how do I balance those dynamics together. The key notion here is, do I want to run quicker today from an investment perspective? Again, in that context, it means I'm less reliant on my sponsor further into the future, and I might have more clarity on my sponsors today and their ability to support the scheme that justifies me doing so. Conversely, do I taking the lower line, taking a lower return target today? Clearly that extends my time frame in terms of getting to that longer term objective, and also extends that reliance on the sponsor. But again, that's a balance of risk and return. So one of the things I will often talk to clients around today is when we think about that reliance on our sponsor, again, how does that fit with that notion of fast track versus bespoke? Is there merit in having a strategy that has more of or I almost liken it to Patrick's earlier slide, where that middle bracket, where it's partially bespoke or bespoke today, as the scheme tries and gets itself further ahead, and then moves into that fast track framework in the next or subsequent valuation from here. So again, taking that holistic approach in terms of understanding where I am today and balancing that scheme and covenant flexibility. Because my key takeaway from here is, again, if I think about risk in investment terms, while I can afford a value at risk measure or whatever your reference to risk looks like today, I can afford an event like we saw in March of this year and still get back on track. We know that in 10 years' time, when the scheme is much more mature, to my previous chart about showing when a scheme is paying out more and more in pension payments, it doesn't want to be running a lot of risk at that point in time. We don't want to be beholden to that, because in practice we'll be much more reliant on the covenant if we have another March 2020 event, and we may not be able to catch up quite in the same way. So what does that mean for your journey? What this chart just illustrates, and again, I'm sure with all advisors that you'll all work with on the call, again, looking at what that journey looks like is a key tool and interactive discussion you should be having with your trustees. Looking at different return paths, how does that fit with the top line you see here in terms of that value of that low dependency liabilities as that evolves through time? When am I going to cross over depending on different investment journeys from here? And that very much going to my earlier tagline around starting with the end in mind. What I'll often say to clients is, given you're having these discussions as part of your valuation, as part of that funding support from the sponsor, let's put a stake in the sand. Let's have a look at where do we expect to be in 5 to 10 years from now, and beyond that, how does that fit with my longer term objective? So again, we're targeting that right level of return supported by the sponsor today to make sure we stay on track. Now, one of the things you may observe is I've in effect talked a lot about that return level and focusing on targeting that right level of return. And that's very much my starting premise when I talk to clients around how do they balance their risks they face. But it's equally important to think about what are the risks. And by separating the two out, I think you get a much more explicit understanding as trustees in terms of understanding the return path that I need, and that's aligned to my goal, and then explicitly think about what are the risks that blow me off course. And I'll highlight a few of the dynamics here that will be familiar to many of you in terms of, in the top left, hedging your liability risks. Again, that notion of interest rates and inflation moving against a scheme can open up a gap in terms of the value of their assets versus the value of their liabilities, particularly if you're taking a more prudent approach to valuing those liabilities. So high levels of hedging is a key tool that schemes should be thinking about in terms of how they put their strategy together. Secondly, in terms of cash flow matching for most schemes today is not necessarily a big issue, but will become a bigger and bigger issue as schemes get more and more mature. So again, how do we manage that income level that's coming off our assets? How do we need to grow the level of income that our assets are distributing? Again, to match the pension payments alongside deficit contributions, but also recognizing that we don't want to find ourselves in a position such as March 2020, where assets have fallen materially and we're forced to be liquidating some of our growth assets to meet pension payouts. Again, that's one of the things that may not be a priority today, but certainly should be part of that journey agenda as you move forward from here. And thirdly, in terms of the bottom left, mitigating our exposure about asset shocks. Again, how the covenant can support the scheme as well as the asset portfolio generates the returns we need without getting blown off course by a March 2020 event or otherwise. And the key point I highlight there is making sure, as I said to trustees, as a sponsor, you're using the full toolkit available to schemes, whether you're large or small. There are many tools available, investment tools out there that are accessible to schemes of all sizes today, that make sure you are having that appropriate balance. Clearly, having asset diversification, investing, not putting your eggs in one basket, but investing across a range of asset classes is valuable. But what are the tools do you have at your disposal? Again, the ability for your portfolio to adapt to prevailing market conditions, to take risk off the table or add risk on the table where opportunities present themselves, but also to what extent have you got protection against sharper market falls? Because the key point for many schemes is today, to get to that longer term objective, we need more investment return. We need that investment return to keep coming through, because that's a key lever for many schemes in getting from where they are today to getting that longer term objective. So what I highlight on my penultimate slide is just thinking about that notion I highlighted earlier in terms of using the wider toolkit. And that stems very much from the three ticks you see on the right, being the need for better risk management, the need for explicit cash flow matching, and the need for more investment return. And using the wider toolkit takes us a bit further away from let's call it the traditional model of having a two-box framework, as I'd call it, being your portfolio of growth assets on the one hand, your portfolio of off-risk or LDI type assets on the other hand, and that balance determining what is my return target and what is the level of hedging or risk management I have together. Again, that two-box approach has served the industry reasonably well over the last 10 to 15 years. But as schemes move towards that longer-term objective, we need more hedging, we need more cash flow matching, we still need return. So again, you can see that on what I typically see more and more, and I'm sure you'll all see this from your trustee perspective, is that discussion you're having with your investment advisor or provider. It should be very much centered around how do I evolve my portfolio to meet my longer-term objective needs, but also manage those shorter-term risks that may blow me off course. I did pick up one of the questions coming through. So why are DB trustees reluctant to look at capital gains in their liquidity plan? To a degree, I think there's a kind of balance of where schemes have come from in terms of that journey, in terms of how they source their liquidity needs. There's a lot of talk within portfolios in terms of today, in terms of stress testing portfolios around how liquid their portfolio is today, and having done that test, great, my assets are daily, let's call it daily priced. I can theoretically put in a redemption request from a trustee to my manager and theoretically get my money back today. But there's two factors that I think are far more relevant to address that point than have been considered in the past. I think the first is a slightly glib point, but when you sell something, everything clearly has a price and people will only pay for that what they're prepared to do so. And one of the things we've noted, particularly in different asset classes over the last few years, is that spread, so that gap between what the asset is priced at, what actually net of cost you can liquidate that asset, has widened progressively over time. And again, how much is that factored into schemes' liquidity portfolios where on the sticker as such, this strategy has, let's call it 80 or 90% liquidity, but actually when you come to sell it, you may incur a transaction cost or elevated cost to get out of that position. So understanding liquidity, I think, is certainly a key point. And I think it highlights the fact that when I've got a portfolio where it's generating return and growth, and I need that growth in terms of achieving my longer-term objective, I arguably want to leave as much of that portfolio alone to ride through shorter-term periods of volatility wherever I can. So again, that balance of using other parts of the toolkit to generate steady and regular income to support my liquidity needs, we feel it will become an increasingly required tool rather than simply harvesting the gains from assets. Because I go back to March 2020, where we saw some schemes across the industry having to meet elevated transfer value activity, having to meet pension payments, also having to meet collateral calls, so where their pooled LDI provider was requesting additional monies to maintain the level of hedging. Again, drains on your liquidity at a time when markets have fallen clearly have a material impact in terms of getting towards that longer-term journey. So my point to clients is be much more explicit about understanding what the risks I have here are, how am I explicitly managing those risks, and having that contingency plans in place to adapt accordingly. So just turning on to my next slide and final slide from here. Again, what are my key takeaways? So again, Patrick's talked about the broader funding regime and how the schemes need to be thinking about that, depending on how they fit within the fast track framework, or even if they're in a bespoke environment for today, and that gives them the angle and the lever to get into fast track at some future point in time. And I think that the overarching point here is start with the end in mind. Again, while technical revisions at the end of the day is a mechanism to agree contributions from your sponsor, in practice, as schemes are closed to new members to future accrual, time frame is coming down. It is shrinking, and by virtue of that, we don't want to find ourselves in a position in 10 years from now where we're forced to re-risk, forced to heavily rely on a sponsor, or just forced to really be running a higher level of risk than we can really desire to do so. So focusing on your end game today is a key point. My second is clearly targeting the right return from your strategy today. Again, if we think about the spirit of integrated risk management, we've probably got the most clarity we have today in terms of where the sponsor is, where the scheme is in terms of its pension payouts, where our investment is today. And what that boils back to is actually you can well afford to take a bit more, target a higher level of return today to try and get yourself ahead of the game and get you into that fast track regime going forward from here. Now, for schemes who've got let's call it a gold-plated bulletproof sponsor behind them, with a lot of financial support, contingent assets, again, maybe less relevant. But I think for many schemes, it goes back to that 50-50 notion Patrick alluded to earlier. There are many schemes who've still got a long way to go to get to that longer-term objective. And the only way they're going to get there and comply with fast track is arguably take a bit of return off the table, which clearly extends their time frame, or get a lot more contribution from the sponsor, which many sponsors can ill afford. So getting that return today is key. And to that final point, highlight what are the key risks you're taking and explicitly address them to give yourselves as much certainty around getting to that longer-term objective as possible. So thank you for listening. I'll pass back to Roger now to address any questions you may have.
Yes, thank you, Ajeet, and Patrick. So we have a few minutes for sort of questions, and so if any of the audience would like to submit a few questions, please do. We'll try and answer them. But Patrick and Ajeet, I've got a couple of questions. I wonder, perhaps the first one is directed to you, Ajeet. I mean, do you envisage seeing more pressure from companies, from sponsors on trustees building asset outperformance into funding packages, and how do you square that with the current uncertain investment outlook? And that's my question for you, but you may want to decide who answers that. And Patrick, yeah. I'm thinking that the new regime sort of gives some interesting challenges for sponsors, because I'm wondering if they'll welcome it or see it as just another lever for trustees to use against them, because fast track seems the right route and works for everyone, but they may not. The sponsor may not be willing or able to provide the robust funding that's needed for that. So a couple of I think, linked questions in some way. Ajeet, did you want to go ahead first?
I'll comment briefly, if I may, and then pass back to Patrick. I think it's a great question, and it is certainly a lever in the toolkit at the end of the day. But I think as trustees, we need to balance how much, let's call it, we place that reliance on the sponsor reliance on the investment returns to, bluntly, sort of lower the level of cash we're getting in from the sponsor. One of the things I will often highlight to clients is you will have a discount rate. You may have a margin, as you've just described, above that discount rate for outperformance of it to, again, make the maths work, frankly, in terms of getting contributions lower. I would always highlight to clients, I'm always looking, given where you are today, to target a buffer above that, to target a bit of extra return where we can above that outperformance measure, so we can again not be overly reliant on arguably the sponsor paying out on time or equally actuarial assumptions playing out in practice. But I think it's a lever to be used in a prudent and risk-controlled way.
Yeah, thank you, Ajeet.
So on your other question, Roger, about will employers welcome this, if I could summarise it in that way, I think employers are a really mixed bag. The more enlightened, pension-savvy ones will probably shrug and say, well, aren't we already doing something that's along these lines or pretty similar? Yeah. So I think for them, the clarity that's within this will be pretty welcome, actually, to know what the rules of the game are. The other employers, the ones who are playing fast and loose, I think they'll start to see the areas that they can play games tightening up, and that's a good thing. If I think about the green paper and white paper, the white paper was forming the view that most schemes do a pretty good job, and it's a few rogue traders that bring us all down. So I think trying to close down the options for those will be beneficial for industry and beneficial for savers. Not going to be beneficial for the naughty boys and girls out there running those firms, but that's not really what we're worried about. And then we've got that swathe of ones that are probably in somewhat blissful ignorance, and they really won't be pleased to see this, first of all. It's going to come as a bit of a shock, but 10 years down the track, when they're not facing a mountain to climb to get their scheme to a decent place by the time everyone's retired, I think they're going to be pretty pleased that this happened with the benefit of hindsight.
Yeah, thank you, Patrick. I find it interesting, actually. It's sort of casting back to Maxwell days. We always see sort of high changes in robustness from legislation or the regulator, driven by high-profile events. You touched on it earlier. So maybe what we're seeing here from the regulator in terms of the new funding regime may help give the security for those savers that the regulator's looking to protect. So we're waiting.
I think you're right, Roger. There's a history in pensions legislation going back several decades of trying to lock the stable door, and the horse hasn't just bolted; he's down the track and over the hill and long since gone. And that is happening here to the extent that we've had BHS and Carillion. But I think we're actually seeing some really good forward-looking outcomes from it, and that's something that we should all be pretty pleased about.
Yeah, I think so. Well, I'm just looking to see if there are any questions for our audience. I think you have both expertly addressed the questions that came in as you've worked through your presentation. So
I think there was one I missed, Roger, just towards the end of mine, about covenant arm being important and how might covenant assessment change how it's approached. I wouldn't mind saying a quick word on that, if I could, please.
Please do.
Thanks. I think it's the newest discipline on the sort of three legs of the IRM stool, and it's the one that's got the most still to develop. I think at the larger scheme, bigger budget end, no real changes. I think where we'll see that changing will be driving down into smaller schemes and probably more commoditised, independent sense check rather than this sort of nodding through. We know the company really well, directors of the company are sitting on the trustee board and everything's just nodded through, actually getting some sort of scrutiny and independent check on that. And I think that's to be welcomed, but there's a lot to be done to build the capacity in the market to be able to service all of those small schemes.
Great final point, thank you. So I think conscious of our time to close down the session, I think all that remains for me to do is say thank you very much to Patrick and Ajeet for their valuable insights. And I think I've taken away some good notes of things I want to tackle when looking at the schemes I work with. And also thank you to the audience for joining us. There will be a recording of the webinar on our website, and we will be in touch. We'd welcome feedback, so we'll be in touch both for feedback and future events. And look forward to welcoming you to a future webinar. So I think it remains for me just to say wish you all a good day and look forward to seeing you soon.